Hey everyone, welcome back to Corporate Decoder. Today, Dr. Horton just filed their 10Q report for June 2026, and I am seeing a big story in their cash flow and inventory. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is showing fewer homes sold, but a growing backlog, and that tension tells a tale. Let's dive into the numbers for Dr. Horton, Incorporated, a giant in home building. They operate in 126 markets across 36 states, which gives them a broad reach. As of the 30th of June 2026, they had over 404 million shares issued. Looking at their financials, the balance sheet for the 30th of June 2026 shows total assets of about $36.5 billion. That is a solid number, but it is interesting to see cash and cash equivalents dipped to just over $2 billion, down from nearly $3 billion at the end of September 2025. Now, where is all that money going? A big chunk is tied up in inventory. Their construction in progress and finished homes inventory jumped significantly, reaching over $9 billion by June 2026, up from about $7.6 billion in September 2025. They also hold a massive amount of land and lots, valued at over $14 billion. This shows they are investing heavily in future projects, which is typical for a home builder of this scale. On the other side, total liabilities climbed to over $12 billion. This includes notes payable, which went up to over $7 billion. It looks like they are using debt to finance their growth and inventory. Despite the increase in debt and inventory, they are still making money. For the 3 months ending the 30th of June 2026, net income attributable to Dr. Horton, Incorporated, was over $904 million. However, that is down from over $1 billion in the same period last year. For the 9-month period, net income was about $2.1 billion. A drop from $2.6 billion last year. This translates to diluted earnings per S-share of $3.2 for the quarter, down from $3.36 a year ago. For the 9 months, it's $7.45 per S-share, down from $8.53. This shows profitability is down, which makes sense given the economic climate. Let's break down where the money is coming from. Homebuilding revenues for the third quarter were about $8.7 billion, a slight increase from last year. But the average selling price of homes closed dropped by 2%. This lower selling price, along with higher costs, impacted their gross margin. The home sales gross margin was 20.7% for the quarter, down from 21.8% last year. This is a key figure. It means less profit on each home sold. Now here is where it gets interesting. While they sold fewer homes on average this quarter compared to last year, their sales order backlog actually grew 14%. The number of homes in backlog sits at over 15,000, valued at $6.2 billion. This means they have a lot of future sales lined up, which is a positive sign for future revenue. The average selling price in the backlog is also up slightly. Moving to their rental segment, revenues dropped by about 32% in the quarter, mainly due to fewer single-family homes closed. This segment is seeing some pressure. Forrestar, their lot development company, saw revenues increase by 4%, with a good chunk coming from land and lot sales to their own home building segment. This shows internal synergy. The financial services division saw revenues decrease slightly and pre-tax income dropped by 14%. This is likely tied to fewer home sales overall and perhaps higher interest rates affecting mortgage origination. Looking at the home building results by region, several areas saw an increase in homes closed for the quarter, like Phoenix and Houston. However, this was offset by a decrease in average selling prices across the board. The overall home building pre-tax income as a percentage of revenues decreased from 13.8% last year to 12.3% this year. This reflects the lower gross margins we talked about. In their rental segment, inventory grew to over $3 billion, with a significant portion in multi-family units. This suggests they are still investing in building out rental properties. Forrestar's inventory is also substantial at $2.7 billion, with a large number of lots owned and controlled, about 91,700 lots. This indicates a strong pipeline for future lot sales. The company's overall land and lot position is impressive, with over 568,000 lots owned and controlled. They are also managing their homes in inventory effectively, with unsold completed homes making up about 23,300 units. They seem to be controlling their supply well. Now, let's talk about cash flow. For the 9 months ending the 30th of June 2026, net cash provided by operating activities was about $880 million, down from nearly $950 million last year. A big reason for this is the increase in inventory, which used up over $1 billion in cash. Investing activities used about $213 million. mainly for property and equipment purchases and a business acquisition. Financing activities show a significant outflow of $1.6 billion. This was primarily due to repurchasing $2.2 billion worth of their own stock and paying dividends. This shows they are returning capital to shareholders while also using debt to manage operations. It is a classic move from mature companies in stable industries. Their debt to total capital ratio is 23%, which is manageable, though it has increased from last year. Net debt to total capital is around 17.4%. They aim to keep this around 20% long term. Looking at the guarantor subsidiaries, their cash balance is over $1.1 billion. The notes clearly show that the parent company, Dr. Horton, Incorporated, and its guarantor subsidiaries hold a significant chunk of the company's assets and manage a large portion of the debt. They have about $4 billion in fixed rate debt, with the 5.000% senior notes due 2034 being a notable part. The average interest rate on their variable rate debt is around 5.3%, reflecting the current interest rate environment. So, what is the story here? Dr. Horton is navigating a challenging housing market. They're still able to sell homes and have a healthy backlog, which is good for future revenue. However, lower prices and higher costs are squeezing margins. Their increased debt and inventory levels suggest a strategy of investing for future growth, even with current economic headwinds. The key will be how well they manage those inventory levels and the market demand in the coming quarters. And the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.